All right. And it is now 1 o'clock. Time to go. Ha, got that last drum beating. That's one of my old wake-up songs when I used to use an alarm clock. Now I get up when I feel like it, except I get up super early anyway, so it doesn't matter. Anyway, good day, folks. Let's see. We have a very exciting market open today, lots of stuff to do, and we will get right to it. Okay, here's the thing. Very impressive looking market, but you have to realize that the Dow is almost entirely being driven. What is this? Oh. It's not showing the Dow's movement. There's the Dow's movement, 136. That's my short. I just took two shorts. So right here, if you want to have an opening play, 2388, I added two shorts on YM. I already have a dozen short on TF, and those got blown up here. But I'm just letting them ride. And again, there's a logic to this because the old CL. Oil's back over 52, so we can look at shorting that. Well, the new oil is at 52.24. The old oil was at 52, is still at 52. So I'd like to see this get up a little bit higher before I start shorting it again. So this is a new contract for December. Oh, I'm going to talk about that too. That's important. But index-wise, you have this really big move in the Dow. Not much in the S&P, not much in the NASDAQ. NASDAQ was red most of the day. And not much in the Russell, although the Russell did just pop. It's an old natural gas contract, so it's spinning. There you go. What was I going to say? Oh, yeah. So, it's 23,000. We're already at 23. You just hit 23,000 for the first time ever. Now we're at 23,100. It's just insane. But it's Boeing today. Not every day is Boeing, but today is Boeing. And Boeing is not Boeing, sorry. IBM. Because IBM is up, let's take a newer chart. Wrong chart. This will do. IBM today is up $14. Now, each Dow component, where's Mr. Calculator? Each Dow component is roughly adds 8.5 Dow points per dollar of movement, and it doesn't matter how much the stock is. So in other words, 10% move on IBM is $15, but a 10% move on Bank of America is $1. So, or probably more than that now. But the point is, either way though, a 10% move on a higher price stock matters a lot more than a 10% move on a lower price stock. It is completely ridiculous. It's a stupid way to run an index, but that is how the Dow works. You always have to be aware of that. So in this particular case, we're getting one of those very major distortions because IBM is up, what we say, 14, so 8.5 times 14, times 14 is 119. So 119 of the Dow's 130-something points, DJIA, 148 points now, so almost 150 points. But almost all of those points are just coming from IBM. And now, how can we verify that? That means we're going to expect to see that the rest of the Dow components, DJI, the rest of the Dow components are probably not doing that well. So we go to DJI in Yahoo is the easiest way to do it for me. You go to components, and you can see how each individual component is doing. And as you can see, Chevron took a dive, down 1.75. Nobody cares about that. Goldman Sachs is still plowing along. They were yesterday's driver. IBM making the big move. So you see $5 added by. So between IBM and Goldman Sachs, because Goldman Sachs is adding 40 points also. So they're adding, these two stocks are adding more points in the entire Dow than the entire Dow is gaining. Did anyone else make a significant move? Chevron went down. JP Morgan up a bit, United Health up a bit. Well, not a bit. Okay, so these guys cancel out. So you have Chevron canceled out by these two guys. Verizon cancels out by American Express. Now you have plus, so they have +1, Now you got minus a half, plus a half. I'm sorry, plus 1 again, plus 1.2, 1.7, minus 0.3 is 1.4, 1.7 minus 0.3 is 1.4. That doesn't count. Plus 1.6 minus but tiny amount, so 1.4, let's say. 2, I'm going to call that. Minus 0.2. Oh, that's interesting because the X one didn't have a big thumb. Minus 2, plus 2, plus 5. So basically, everybody else, the entire rest of the Dow, all the other 28 components of the Dow, are only plus 2 net. That was just a quick look. But generally, they're plus $2 between the group. These guys are plus 20 almost. So they are completely running Dow, just IBM and Goldman Sachs. And even when you look at the bigger picture, oh, there's Exxon. So Chevron's getting killed, not Exxon yet. That's interesting. So I'm not sure why they're not following suit, but that's a different investigation. The bigger investigation here is let's take a look at how much has IBM contributed to the bigger run. And since the election, not much. They were up, then they went down, now they're up. So recently, yes, they've added a lot of points. They've added 20 points recently, but not a big mover on the whole. How about GE? Not GE. Boeing was the other. Boeing's a really big one. Boeing has been crushing the Dow. Look at this. Since the election, Boeing has added over 100 points. That's 850 Dow points since the election. That's huge. And Goldman Sachs is another one. Wow. Goldman Sachs, also 100 points. So that's another 850 points. So 1,700 points from Goldman Sachs and Boeing. And Apple, $1,700. Somebody remember that for me. Apple with 50, so they're good for 4 something. So 17. So those 3 stocks, Apple, Boeing, and Goldman Sachs, between them are good for more than 2,000 Dow points. How much? What the hell? That was weird. Where that came from? DJIA. So how much is the Dow up since the election? The Dow is up 18 to 22. So to 23, really. But about almost half of the Dow's gains since the election are from 3 of the stocks, from Apple, Boeing, and Goldman Sachs. So if you want to know if the Dow's move is real or not, you have to think about whether or not those stocks are emblematic of their sectors. So in other words, does Apple's success mean all tech companies should be successful? And not really. They're kind of unique. So I wouldn't say that you could extrapolate that Apple, because they're doing good, means every single tech should be doing good and the whole S&P should be up because of Apple. All right? If Walmart were driving the Dow, and Walmart's another big one. Okay, Walmart's actually added a lot of points too. If Walmart's driving the Dow, at least you can say, well, there's retail sales are doing well, or theoretically. Well, see, they're up and nothing, it's only 15 points compared to the other guys. $250 for the other guys, so not a big move, actually. It's just been up significantly recently. So where was I? Yeah. So you have to look and think about it. To say Apple, does Apple's success indicate all stocks are successful? No, they're very unique. They have the phones, they have a new product cycle, so on and so forth. They're a leading company by a mile. Their success in some way damages other companies. It damages smaller phone companies and stuff who can't compete. Then we look at there's Apple, and yes, it's IBM today. So now IBM has been down for ages and ridiculously underpriced. And in fact, it was a runner-up for our stock of the year for this year because we thought IBM was going to pop. but I just wasn't as sure of an IBM trade as not that I thought that Silver Wheaton was better. We went with Wheaton Precious Metals. And it wasn't that Wheaton Precious Metals was going to gain more than IBM. It was I was more sure I could make a good play on Wheaton Precious Metals. So we bought it down here. It's now at 20, but our spread, we already cashed our spread when it was at 22. And we have a second spread now on this one. Because that was the point, was we thought this was just a definitely supportable bottom at the time back here in December when we called our trade of the year. It was in a better position than IBM. It's not, the trade of the year isn't so much about whether or not it's going to be the best performer of the year. It's about whether or not we have the best chance of making a very high profile, a very high return option trade. So you see, back in December, IBM, if IBM had been at 140, it was going to be our trade of the year. In fact, it was the trade of the year when I was looking at it first into November, but it was too early to call. By the time we got to December, IBM had popped up to here, where I did not want to make it the trade of the year because it was too high. Now it's back to where it was in December. So that's why Silver Wheaton became the trade of the year. It was the single trade I felt the most likely to return at least 300% on an option spread. And we have crushed those numbers, so it was good. Now IBM at this point, well, IBM yesterday, in fact, we called out a spread yesterday. I think it's up. It was $75, and now it's over 1,000. So in one day, we've made God knows what that number is, 10 times. It's a 10-bagger from yesterday, the IBM spread we did yesterday afternoon. That was a top trade order too. So, at 140, I love IBM. At the 140s, I love IBM, and I'll always call it. We played it here. We already have it in our portfolio, so on and so forth. But here's our number. This is where we like IBM. It was just timing that made them not our trade of the year this year. But I've been loving them at this price, and I can't believe they came back to this price. That was just incredible to me. So it was a no-brainer yesterday to play them for earnings. Back to that. So IBM doesn't indicate there's some phenomenal thing going on in tech. It just means IBM's getting their shit together. Okay? So that's a very technical trading term, by the way. So IBM is just showing their earnings or just showing their turnaround strategy is finally working, dropping money to the bottom line, so on and so forth. So IBM drags the Dow up, but it shouldn't mean that the whole market should be following. Apple, same thing. And then the last one was Boeing, and Boeing obviously is extremely unique. The fact, Boeing's in a new plane cycle because they've retired the 747 after 30-something years, and now we've got the new planes, and this has been going on for 5 years. Everybody's been ordering the new planes. Boeing will be delivering these new planes for 20 more years, and they're going to make incredible amounts of money. They have. I didn't want to say the number. They've got. I think it might be $100 billion, but they've got at least $50 billion worth of back orders. And Boeing, they've got back orders for like 10 years at Boeing. Let me see what their annual revenues are. I'll tell you for sure. I remember the ratio. Oh wow! No, I'm sorry. They have $500 billion worth of back orders. They have at least 5 years worth of revenue in back orders. They have $500 billion worth of back orders. They are going to be profitable and doing well for many, many years. And that was a no-brainer. We stopped playing Boeing because it got so expensive, but on the whole, it was a no-brainer play when it was lower. We loved it. It was in our portfolio. We already cashed it because it just went so high. I don't think we have any Boeing left. It's just completely off to the races now. It deserves to be where it is. But again, does this help anyone else? It helps the companies that sell aircraft components and whatever. And we had some stocks like the Boeing buddies, and in fact, ATI was one of them that we just jumped into recently because of the Boeing buddies, and the Boeing buddies are the people who supply Boeing with parts. So of the Boeing buddies, ATI had not moved back here, and we jumped into ATI, and now it's gone up too. But again, there aren't that many companies that directly will make money just because Boeing's making money. It's a unique situation. So we have three pretty unique situations driving the Dow to record highs and accounting for more than 10% of its gains. Now, as far as so what you would say is that they're responsible for 10% of the 20%. They're responsible for half the Dow's gains since the election. Do they not deserve to be where they are? Yes, they do. So you can't look at that and say, well, then the Dow should correct. Well, why should it correct? Because they are correctly priced. They have good reason to be at those levels. The other stocks that went up with them may not deserve to be where they are. So you could say that 10% of that rally is probably overdone. And I would say maybe overdone by half. So again, it goes back to the same thing again, that we're looking for a 5% correction, which is 1,000 points on the Dow. But we are looking for that kind of correction, a 5% correction on all the indexes. That's about how overvalued things are. And this is just sort of like a data check to say this is our premise, this is why we think that, and this is what we expect to happen. But it also means when the market does correct 5%, we're going to start being very interested in buying things. And if the market corrects 10%, we're going to consider that fairly a bargain. And that's why we moved up the lines on our big chart, which you can see here. Where's that big chart? Sean Luke. There it is. Okay, so on the big chart, we've moved up our numbers, and the Dow, we're saying must hold 21,000. It's already way up there at the 10% line. S&P and the NASDAQ are above their 10% lines already. So we're looking for corrections down around this 5% line, and we're going to be happy buyers as long as the must-hold lines do hold, with the NYSE being the lagger at the moment. When the NYSE, which is a long way to go, when the NYSE is over 12.8, we're going to be into a new leg of a new rally, and these things are going to start flying again. And the bubble's not over. And I don't know that the bubble's over. I really don't. There's no way to call an end to this thing. Just like in 1999, you could not call an end to what was happening. And look at it, it's still popping right now. But I am saying, though, that specifically today, this is really being driven basically by IBM. And yesterday we had yesterday's pop was from Goldman Sachs. Today it's from IBM. There's not, you have to see other stocks take the reins and be able to sustain the gains that they're making on the tails of these guys. And you can already see today all the other Dow components, except for IBM and whoever the other one was, Goldman, except for IBM and Goldman, are basically trading even. They're trading flat. On a 145-point up day, nobody's net interested in any of the other 28 Dow components. That is not a sign of market strength. I know it's weird to think of it that way, but it's not. All right, so we will just see what happens. All right, let me do some questions, see if anybody's got something to say. What's up with NG? Well, I don't know what today's deal is. I'm going to have to look at it. Let's look over here. Got too many of these. This is confusing me. Go away and go away. Okay. Now I feel better. All right, so energy, natural gas, they're just having a bad day. But this is the line we like to buy them at, this 280 line. See, it's been held in August very well. Held over here. Hopefully we can get another shot at it and add some more stock over here. It even held here except for this little spike below. Now, don't forget, though, I think we talked about this before. And here, I mean, look at 280. It's a good line for a whole year. It's a really good line, but it does go down to 260. And 260 at natural gas is this is a $2,000 per contract drop. So you have got to be, ready to take that, or you better be setting your stops very tightly below 280 and just get back in when it comes back above. because each one of these lines is $2,000, and it can easily fall down to 260. Look how quickly this happened in like a day. This is days, daily. These are days. One day, two and a bit $1,000 in February. That is nasty. But you know what that is? That's all they're doing though is flushing everybody's stuff. Is flushing the stops. They were coming down here. They were going to go higher, but before they go higher, they want to force all the stops, get everyone to capitulate, so that all the speculating contracts where people are speculating long get forced out. They get to accumulate them and hold them, and then when people scramble back in, they get to leisurely sell off over here. That's the game that goes on all the time in the markets. So a lot of times when you see a really big move down and you don't know why, it's because they're about to make a big move up and they're just head faking you. I just saw somebody open up another natural gas terminal. The exports are proceeding at pace, but it's such a slow process because these terminals take so long to come online, and once they're online, they take time to ramp up. It's not having a big effect yet. It's not going to have a big effect until into next year. The contracts we're trading now are the NGH8. That's next March's contracts, because this year is done. So we're trading the H8s because we don't want to deal with this bullshit. We just want to keep accumulating the H8s until we get a nice bump, and then we'll lighten up, and then we'll be able to hold on for a while longer. But you cannot play the short term. The short term are probably going lower. That's why we're not playing the short term contract. Qualcomm, I have 219 spread. What would you recommend for a 2020 spread now? SBU, sell up due to weak and or something else. Oh, weak margins. No, I don't know. They acquired somebody, and I don't know what happened. Somebody had to put out a bad note. I haven't seen it yet. Everything was all happy this morning. It was weird. Let's see, SVU. You can probably see it on this guy. Oh, no, I'm not going to see that. SVU? Where's the chart? Oh, I see. I click on the chart. Down 10%. That's so unfair. Let's see what they're doing today. Look at this. We gapped up at the open to 21, and now we're down to 17. That's a 20% move. That's really crazy, and there's nothing here. There's no super value expanding distribution limit because they're moving from retail to distribution. That's their plan. So I'm not quite sure what people want them to do. They beat the estimates. They bought somebody. I guess people don't like the acquisition. I don't know. It's weird. 6 hours ago, 5 hours ago, 4 hours ago, 2 hours ago, even 2 hours ago, well, this was 10 o'clock, so 3 hours ago. So something happened between here and here. Let's see what the Wall Street Journal said. Maybe they said something weird. I am not finding it. Jackie's account. All right, screwed. Anyway, so I don't know what happened, but something happened and it went down. It doesn't affect our overall long-term view of super value. We have them in the long-term portfolio. Which is probably up 1 billion% right now, 230%. Jeez. $1.65 million. That is nuts. That's from starting basis $500,000 in November 2013. So we're coming up on our 4th anniversary, and we're more than triple. All right, SVU. So what do we have? We don't have many shares actually. Oh, isn't that weird? I think this is a good time to add more. We have the 1325 2019 bull call spread. We aggressively sold the 27 put short. And I think this is probably going to be a pretty good time to double down. I'll be doing the long-term portfolio review, tomorrow and Friday. I got to do all our portfolio reviews. So we will see where we end up. But I feel like this is a good time to make that move. These things don't even, we only have 7? It's because they did that reverse split and it screwed us up. 7 is like such a little amount. We can definitely do way better than this. So let's go. We will establish a bigger, better position on Super Value. I still like them for sure. See what they cost. SEU, do they have 2020s is what I want to know. No, not yet. So we have the 13. Oh, well, see, we have the best. We have ones that are perfectly adequate. We have the 13s. They're at $7 or something like that. We sold the 22s or something for $3. You're not going to do better than that spread. That's a good spread. If I was doing it from scratch, I think I'd go with a 15-22 spread because there it's only 565 minus. Not that number is ridiculous. 565 minus maybe 275. So it's only $3 for the $7 spread. That's a good deal. And then you could sell the $15 puts for $250, $260, and that nets you in for 40 cents on a $7.50 spread. So why would you not do that? Especially if it's in the money. You're buying the $15 call. So that's the way you play that one. That's fantastic. What do we have? We have the 13.25, but we have an even wider spread. And the thing is, we sold the 27 puts. So what we can do, though, is roll our puts, 27, 10.50. We can roll them down to like 2 of the 18. So we'll lower our bases considerably, and then have a much more realistic target. So probably we'll do that, and probably we'll roll 7 to 15 of the 18 puts. And why am I doing 15? Because I can't stand it when it's like 14. It drives me nuts. Because I do the math in my head all the time. So I prefer to have like chunks of 5 at least in anything I'm buying. That's the only reason. So we're going to roll 7 to 15. It'll be a little bit less than even roll for us. And we'll do like the $18 puts or something like that and sell those short. But that's an easy fix. And it's a good, really good stock to hold. And then we'll have enough to sell calls against. If we run them up to 20, we can start selling some short-term calls. So all good. Lots of good things about that, actually. It's not always bad when a stock you like gets cheaper. Sometimes it's an opportunity to get more. Qualcomm. Oh, yeah, Qualcomm. I'm sorry. I have a 2019 spread. Would you recommend for a 2020 spread now? Where is Qualcomm? You're playing them. QCOM. I think all we did was sell puts. Nope, we changed into spread. So what we did in the long-term portfolio is we sold the January 50 puts in 2019, and we bought the 40-55 spread, and we netted into that for pretty much zero. So we have a free shot on a $15 spread that's essentially in the money. Wow, that's great, huh? So this will pay $15,000 if all goes well, and currently the net is 13 minus, 13.8. So call that 8.5 minus 2.65. So currently it's $6,500, but it's a $15,000 spread. That's pretty freaking good. Let's take a look at what we could do in 2020, though. That was a question. What was I just saw? Oh, my God, Larry Sanders. Not Larry Sanders. Damn it. Larry David. Curb Your Enthusiasm. The episode from this weekend was hilarious because it just reminded me of the way I was trying to answer that Qualcomm question. The guy, the maitre d' at the restaurant, would answer everything in this crazy, evasive fashion so that you talk to him, but he never actually says anything. Like it's every question he got asked, he would deflect and move it around and change the wording and whatever, and then he would say, "So that's what it is." And the guy and Larry David was like, "What? What the hell?" He was the only one calling him out on it. Everybody else thought he was like being so nice. So anyway, so to answer your question, not like that guy. Oh, look at that! Wow, you can sell these $45 puts for five. See, now my attitude about Qualcomm is I certainly think Qualcomm is going to hold 45. So I would feel comfy selling the $45 puts. You could just sell a few of those though. You can sell, like, if you sold 5 of those for well, let's say $5 a TV for $2,500, you can get 520 of them. If you sell 5 for $2,500, you could then apply $2,500 to the 45, which are 1050, let's say, minus these guys, minus the 5750s, and you're practically at 5750. You're not asking for a lot of movement, but you can go with the 5750s for sell this for close to 5. So we call that 1050 minus 5 is 550, and then half of that would be 250. So for net 3, you could be in these 1250 spreads. So it'd be the 45, 5750 bull call spreads, double 2 times those, so 10 of those, less 5 of the short 45, and that would net cost you $3,000, and the spread, if all goes well, is going to pay you $7,500. No, I'm sorry, $12,500, which is a $9,000 profit, a $9,500 profit. So that's a nice spread. So you're going to make $300. This is the kind of things when we look at a trade of the year. That's the kind of things like it's going to make the 350% that I want to make. Now the question is it the best trade? And that's what we do when we do our trade of the year. And I don't want to jinx it, but we've never missed. But it's because I look at it and I say, okay, there's a contender. It's going to make 350%. But is it the one I am most sure about on the planet Earth? And that's what it's all about. So with Wheaton Precious Metals, which was Silver Wheaton at the time, I was positive because silver was so ridiculously cheap last November. It was stupidly cheap. Qualcomm, I wouldn't say stupidly cheap. They have that lawsuit thing with Apple going, although technically they can't lose, but maybe they can because it depends on how much people think, how much are people counting on Qualcomm winning the lawsuit. That's a mistake analysts make a lot when they're evaluating lawsuits. They always look at it and say, well, Qualcomm can only gain if they win this lawsuit. That's not true because you don't know how much of the potential gain of a lawsuit is already priced into the stock. And you have to take that into account. People are expecting Qualcomm to win some kind of concession from Apple. If they get no concession, that's losing. And then the revenues they're anticipating will not be there. Not only that, though, it means every Tom, Dick, and Harry on the planet can copy the chips. An $18 chip trade. Such a weird thing to have a lawsuit over. And every iPhone, there's this $18 chip that Qualcomm makes that Apple apparently is not seeing the proper royalty for or something like that, and they're in a big lawsuit. It's a $1 billion lawsuit because of just how many $18 chips Apple sells. But it's really kind of kooky. So where were we? Oh, yeah. But Qualcomm is always in lawsuits. I mean, Qualcomm and Broadcom's whole business is about patents and lawsuits. I mean, that's their job. But this is, Apple's a big one, obviously, compared to a lot of other ones. And that's the thing. Usually they prevail because they go after people who are like, for the tiny amount of money it's going to actually be, they can't be bothered. But in Apple's case, Apple's plus or minus hundreds of millions of dollars on the outcome. They're certainly going to throw $5 million to the top-notch legal team to see if they can wrangle out of it. So that's where we're standing on that one. So I like Qualcomm. That's a great trade. I feel super confident. As I said, the 2045 puts to me as a complete no-brainer. But the question is, would it be a trade of the year kind of thing? No, it would not, because I really just need it to be a little bit lower. If it were down at 45 now, if it were 40 especially, I would then make it a trade of the year, and obviously we'd have lower strikes. But at the moment, I think it's a great value. I don't think it's the best value of any stock out there. But if you like Qualcomm, you want to play it, I certainly endorse that trade. And what's my thought on SNCR? How are they doing? What do we got here? Kind of looking. Oops. They down. Oh. Why share? Oh, what is it? These are written by computers. I want to see what the computer says. Synchronous tumbled one day after the company announced it was selling Intralink business for $1 billion. So, wow. Okay, so there is news. They sold the Intralinks, and they will make 185. They're not really getting $1 billion because they have to flip 185 million back. I hate those kind of deals. Synchronous, if you can get wait a minute. No, Cirrus will make it. No, wait. No, wait, I got that wrong. Sorry. So the guys buying the unit are going to pay another $185 million and own 20% of Synchronous. That's not terrible. Why is this being looked at as a bad thing? It's convertible. I guess it's dilution. There's substantial dilution of the stock. They got that. They announced it. So January 19th, October 17th. This deal's been going on. This timeline is nice because you can compare that to the chart. And let's see, hang on. So this all started in January, and nobody's liked this deal. And now that it's complete, everybody hates it. That's interesting. I would have to look more at it, though. I couldn't tell you right off the top of my head whether or not it's a good deal. I haven't been paying attention to what they're doing. It's weird how much people hate this deal, and now that it's completed, they hate it just as much, and they're killing the stock over it. Oh, well, well, there you go. There's a problem, though. See, they sold off this unit, but then what's the company actually worth without the sales and whatever from that unit? So I don't like it. These numbers wouldn't be adjusted. This is just their crappy performance last year. And now they're selling off this unit that maybe that unit's the only thing that's profitable. Maybe this is the death of the company. And I don't know. I don't know either way. I don't want to, I'm just raising the question that my concern is that these investors do know what they're talking about and that the unit they're getting rid of is the only profit they're going to make. So big deal. They got $1 billion now, but what's going to happen to the company? And their whole valuation is $500 million. That's crazy. So I don't know enough about them to know where they're going and what they're doing next and what they plan to do with $1 billion. I think it's interesting, kind of take a look, but I wouldn't rush to put money in until we get more information. Well, what you want to find out, those are the big questions, is how much money has this been generating for them, and what do they think they're going to do? So they've got $1 billion cash, low valuation. You think, like, great, but how much are they burning? What are they burning it on? What do they do? We'll see. Oh, also, by the way, when a company gets a great big cash payment like that, especially if it's a profit from if they have to declare it as a profit from the sale of the group, then they're going to look very hard to take very big losses in the current quarter because they want to book a big loss for the taxes going forward to offset the gain. Otherwise, they have to pay corporate taxes on the gains. So that's another thing you need to be careful of, is because they may be stabbing themselves to make it look like they don't make any money because they don't want to show $1 billion profit and pay tax on it. So all kinds of weird stuff going on. That's an interesting one. I like that. Where's that thing? Oh, you're in it now? Oh, that's interesting. Yeah, remind me during chat, and we'll check it out some more. I'd like to know more about it. It's an interesting story at the moment. Ugh, all right, anyway, so what's going on? Are we up to 200 points yet? How we doing? Oh, stop to 2,300. Are you kidding me? Come on, Dow. And my Russells aren't helping. This is, since we did this last week, been in that several times. I mean, obviously, here we cashed in, and then we came back over here. Or I came back over here, but I got burned. So I ended up with now I have a dozen. Actually I have a. So now I got burned because I was sleeping. I'm sorry. I wasn't sleeping. What was I doing? No, that's what happened this morning. I'm sorry. This morning I got burned because I was in a meeting, and this happened while I was in the meeting. So I added some more, and now I'm back to being burned at 12 at 1503 on the average. So if it comes back to 1503, I'm going to drop back to 5. And I still in this for the long term. I really think the market's going to correct, and we're going to drop probably 100 points on the Russell, which will be like 10,000 per contract. So I'm actually looking for like $100,000 winner here, 50,000 at least. So that's what I'm holding out for, and we'll see what happens. What else is going on? So we got these. So everybody's back to the highs. And when did it start happening? So when Europe closed? Yeah, when Europe closed, everybody said the buyers all the sellers were from Europe, basically. And now that Europe's closed, everything's from 11:30 is Europe's closed, so from 11:30 on, everything starts going up. We have nothing but buyers in America. They buy everything. Nobody's selling anything. Oh, okay, I will tell you, I just today just put both of my kids' college accounts in cash. Because they got those 509, 429, I don't know, whatever the number is. They've got those college accounts I opened up when they were young, and they've got all the money they need for college is definitely in there already. And I just don't want to. I'm out. That's it with it. I cashed out. So just to let you know where my mindset is on this stuff. If we go up, I'll go half back in. If we show that we're going to break over these levels here where we are now, but on the whole, I would rather be in cash pretty much into January. Better to be in cash into January than risk my kids' college fund on this insanity. All right, and obviously I haven't done that before. I haven't had that statement before. Not since back in 2008. But at this point now, and the same thing goes for our portfolios. I'm going to be seriously considering moving to a lot more cash in the portfolios. We're already very well hedged though, so I'm not super worried about the portfolios. But I can't without doing a lot of tricks. I can't hedge the kids' college accounts. It's basically, they're very restricted what you can trade in those things. So essentially, you're either long on ETFs or you're not. And so I just couldn't risk being long on these ETFs that have made such silly amounts of money in the last couple of years. Silly amounts of money. I mean, my kids are good for graduate school at this point. So why would I risk it? They're going to go through school debt-free. It's like, why would I risk anything else? So, but I just that is an important thing. I want to tell you guys that's how I feel, because I actually looked at that today, and I called them up and I said, "How much is in those things?" And I was like, "Okay, that's it. Let's kill those." I just don't have a good feeling about where we are right now in the market. Too much weird stuff going on. Plus that thing. Wait, I'm sorry, I totally lost track of my day. I didn't talk about this yet, did I? What's his face? Mnuchin. I wrote it, but then I didn't talk to you guys about it. Where is it? Our man Mnuchin says, here you go. In a political interview this morning, Mnuchin, who said there is no question the rally in the market has baked into it a reasonably high expectation of us getting tax cuts and tax reform done. So to the extent we get a deal done, the stock market will go higher. But There's no question in my mind that if we don't get it done, you're going to see reversal of a significant amount of these gains. Now, I think he's wrong. I don't think significant is really a little overstatement. I think, as I said, we're looking for a 5%, maybe 10% correction in the market. Otherwise, a lot of these gains are justified. And justified, whereas, let's go back to that. We'll show you what Nabob said also. So, to some extent, it's scare tactics. To some extent, it's true. It's any good scare tactic's got to be a little bit true. But they're really talking about this tax deal like it's going to be the savior of everything, and it's just not. We don't have the budget for this kind of thing. It's not going to fly through. You can't do it. You can't cut taxes like that. You can't stop collecting the inheritance tax and stop collecting corporate taxes and do all these things to all people and then do what? Have the debt be $2 trillion a year? It's insane. Even if it does work, it would take a year to work, and you're going to blow the debt up for at least a year after it, but the reality is it's never going to actually fix anything. We've done this before. Kansas has been doing exactly what they want to do, except they've been doing it for years, and it's destroyed Kansas. They've got the Republican House, Republican Senate, on the state level. They had a Republican governor. They passed every single tax-cutting bullshit thing they could, and it tanked the state. And not a dime went to the people. It was all bullshit. And the same, it's a story sounds good, so they're using the same story that they used in Kansas to get it. That's how they all got elected. But it doesn't work. And the only way you'll know it doesn't work is after the disaster. They go, oh, gee, that didn't work. Just like the Bush tax cuts didn't work and the economy collapsed. But that was so long ago, 10 years now, that everybody's like, oh, well, let's try it again. I don't understand it. And we can't be saved the way we were saved last time because we already spent all our money saving ourselves once. It gets out of control if we try to do it again. Anyway, all right, enough of that. I'm cautious, and I am looking for a correction. Now, Nabob, he said something interesting earlier. That IBM, I think. No, it was McDonald's. That's what it was. Okay. Because this morning I was talking about this, and Nabob had a nice little statement that he was talking about as an example of what goes on with these corporations and the earnings. So, I was talking about the buybacks and how it's corporate buybacks, and it makes you think that companies are making more money than they're actually making. So he's saying since 2012, McDonald's revenue is down 12%, while earnings per share are up 17%. Is it more efficiency, great management? No, it's similar revenue. The net income is minus 8%. GAAP, generally accepted accounting principles, net income is actually minus 8% over the same time. But what's happening? They have 20% fewer shares. So 8% less earnings divided by 20% fewer shares. So, here, stupid math tricks, right? So, in 2012, let's say they made, let's say they made 100. Well, yeah, let's say they made $100 divided by 10 shares. Okay, so now that comes out to $10 a share. So now they have 8% less income. So now they're making $92, but it's divided by only 8 shares because they have 20% fewer shares. And now it's 11.5. So it looks like that EPS, it looks like a 15% gain. They went from 10 to 11.5, even though earnings, actual dollar earnings, went from 100 to 92. The difference is you're dividing the 92 by a smaller amount of shares. That is essentially the entire EPS gain, earnings per share gain of the entire market. Okay, I want that to sink in. I want you to understand what happened. They used to divide $100 in earnings by 10 shares, and that gave them $10 a share. Not specifically 10, these examples. And now they earn 8% less money. So in 5 years, they make 8% less than they made 5 years ago, but they have 20% less shares. Every year they've been buying back 4% of their shares, basically. And now they have they only have 8 shares to divide by, and you get a much bigger number. So it looks like you're making more per share every year, even though your company is actually dying. And again, I'm not saying McDonald's is dying, but I'm just saying this is what's going on with the overall economy, the revenues. And that's why you say, well, how come the economy isn't better for the bottom 80%? It's not better because it's not getting better. It's getting worse and worse. We're masking it over with all this bullshit. We are lending money to corporations at 0%, and they're taking that money and they're buying their own stock with it. This does nothing to improve the economy. It doesn't create a single job. It creates the illusion that they're making more money. We're paying to be lied to. And we are paying because our Fed is giving money out at rates that are unsustainable. And when rates go up, they will take a loss on them. The Fed's $4.5 trillion balance sheet is money they've lent out at 0.25%, basically. So when rates go up and inflation does kick in, they will be losing the difference between 0.25% and whatever the rates turn out to be. And those losses will be booked on the Fed's balance sheet, and they will transfer to the Treasury and become part of our national debt. And it will be trillions of dollars in losses that get added to our national debt. And that is why you are funding all these corporate bailouts. So he says, the reduction in shares against the Wall CPS, when adjusted decline in shares. I should talk about this next time on TV. That'd be a good topic to explain to people on TV. EPS didn't increase by 17%, actually declined 7%, blah, blah, blah. Okay, that's all what I said. Meanwhile, shareholder, okay, so you're saying there's a loss of shareholder equity, you've taken on debt in the company, and God forbid, when interest rates go up, all this debt that they've taken on, that increased $16 billion in the company. So not only are we getting stuck with the debt, but the shareholders of McDonald's are getting stuck with the debt. And they think they're doing well because the earnings per share are increasing, and they're ignoring the debt because the debt's serviceable when it's at 1% or 2%. But when that debt goes to 4%, 5%, 6%, they're going to look like a company is in deep, deep trouble. And they will be in deep, deep trouble. And that's how you take, and this is how this financial engineering, you take perfectly good companies that probably should have expanded. They should have, McDonald's should never, maybe they should never have rolled off Chipotle. Don't forget, McDonald's sold Chipotle, spun it off to collect the money so that they could buy back their own stock. So McDonald's got rid of a massive thing that gained phenomenally after they got rid of it, but it was too late. They wasted the money on their own stock instead of sticking with Chipotle and growing. And instead of trying to drive more money to the bottom line all the time, which is what most corporations do, they should have invested some money in long-term things. And Google does that, and Apple does that, and IBM does that. There are companies that do invest in their long-term future, but they generally get punished for it. That's why they all have low multiples, because they don't take all their profits and redistribute it to shareholders and do stuff. Now, Apple buys back plenty of their own stock, but they also invest in the future, which is why we love them. Apple's actually got so much money, so they got $250 billion sitting in cash. They don't know what to do with their money. Anyway, so that's what's going on, and that's, again, it's one of the underlying reasons I'm very suspicious of the market and where it is now. He said, well, the Dow's up 150-something points today. It bothers me a lot, and it's getting worse and worse, and it's so distorted. This is a massive distortion, and it's happening in so many companies. The buyback thing is just an overriding concern, because they can't keep doing it forever. As rates go up, they can't buy back anymore, and all these warts are going to come to the surface and become a real obvious thing. Oh, you had the OPTTs? Great. I love those guys. This is the company makes buoys, Baba buoy. They make a buoy that floats in the water, and it captures the waves, cause it to generate electricity. So it's really cool technology. I love it. And they're a Jersey company. I worked with them when they first started raising capital. Like, oh, I don't even want to think about it. It must have been 20 years ago, or close to. When they first started raising money, I was working with these guys. I like what they do, but it's been so long to try to get the thing, and they just got their patent approved. I mean, a major patent approved. It's such good stuff, though. I'm really happy. Any plans to add a spread on Joe? No. Joe has been just such a dog. It's such a frustrating thing. So no. I mean, I like playing KC, but you gotta get in and get out, and the spread doesn't really let you get in and get out. So playing coffee, we've been heavily rewarded. We started last June. We got out here. We got back in when it came back down. It went even lower. We kept buying, and it got back out again. Then it went lower and lower and lower and lower, and it took forever to come back. And now it's back to the way bottom again. I do like it for a long-term play, but you can't play this. You got to just get out. You got to play the little down trough and get out of the spike. So next time you play it here at 16 long, I mean, you can do Joe, but I mean, I'd rather buy the coffee futures so you can get in and out real fast. And when it comes anywhere near this thing, get out. It's probably going to get rejected and go back down again. This thing's going to be ages and ages before it has a proper breakout. Now, our premise on coffee is that global warming is going to screw up the crops, and that means there'll be shortages and, random droughts and shortages and things like that. Just like California. Now, see, it's interesting because California has these wildfires. Could have just as easily have happened in coffee fields. It's like, you could have had drought and then a fire and whatever. Anywhere this stuff could have happened. The Cabernet. Yes, the Cabernets are going to be real expensive this year because they're mostly destroyed. So anyway, our premise isn't fire, but our premise is just generally coffee is a very, very touchy thing to grow, and it's difficult to replant because generally they're growing it on mountains. You want to grow them on mountains at a certain elevation. This is how touchy it is. It grows best, on certain mountains at certain climate areas and certain bands of climate. You find a mountain and you grow it between 3,000 feet and 7,000 feet. Well, don't grow it higher, you don't grow it lower. And that's where they grow the coffee. So imagine when the whole band moves, you got to find whole other mountains and start the cycle. It takes 3 years to replant crops. It can get really bad really fast for coffee. Hasn't yet. Nothing really bad has happened yet. There haven't been any major supply hiccups. But consumption is still going up, and everything else is there. So I certainly like KC especially for long-term play. Soft coffee monthly. See, and see Joe, and that's the other thing. Joe, as you saw, was deteriorating. Coffee isn't really deteriorating. We liked it here. Weekly. This is where we were picking it last year, like 2016. Here. In this time of year last year, we liked it at this level, the 120. It was down at about 116 or something like that when we started playing it. So I guess we must have started in March. So our premise began here, and we got out here, of course, and then we started getting back in here. That didn't work out so well, and now we're definitely back in here, though. This is where we last entered. And we're looking for long, though. Basically, it's a long-term long. And when we get a pop, so from 124, might go lower, probably not too much lower. And then when we get to a pop to 140, you got to take at least half off the table and keep tight stocks on the rest. this is big money. These coffee contracts are really expensive, so it's great to play for these pops. But you got to have the ability to deal with these drops also, because that, again, remember that the spike down before it goes up? They flushed everybody here, and then it went flying up. But if you get stopped out on the flush, you did. Then you just lost. So it's a tough thing to play. As are most commodities. They're very tough to trade. Did they make any money? I bought land for each of the twins when they were born. What? I'm sorry, I can't follow this whole conversation. Did they make any money on their college funds? The college funds are up huge. Oh yeah. Oh no, they're up 150%, and that's from making pretty conservative investments. They're in good shape. They're fully funded. They're funded all the way to grad school, basically. Yeah, which is really awesome for me. Although I told my wife, I told her a couple of years ago, I said we should move to England and establish residency so that the kids go to free college, and then we save we would save on the two kids about at least $500,000. All you have to do is move to England, establish residency, and send them to college there for free. Pretty simple concept. That's why I'm like, it's like getting a free house. You just move there and like you buy the house with the money we're going to save. But she didn't go for it. Plus my girls have Liquid Metal and Northern Dynasty and things like that. So they got some fun stuff anyway. So that's their own money. That's their private money, not their college money. Yeah, college financing. Yeah, me too. My kids are Maddie, because she's the one who's going to college next year. She's going for financial aid and doing whatever she can. I mean, I don't get it. When I was a kid, financial aid was for people who didn't have money, and I don't understand how they do it. But apparently, she feels that she's eligible for some things. A couple of scholarships and some aid packages. I'm like, God bless. Go ahead, save money if you can. So it's crazy. The whole college thing. But anyway, I mean, you should give aid to everybody when you're charging $50,000 tuition, though. That's just sick. I mean, they have the price of college is just completely insane. It has to be stopped. What are your thoughts on GNC? I like GNC. I don't know where they are today, but I mean, I like them because they're turning the company around. It's a long-term turnaround story. I think value-wise, they're good. I think, look, people will buy bullshit that I'm not a big believer in vitamins, but it doesn't matter. People have been buying snake oil for 1,000 years. Okay, they will always buy this stuff. So it's a nice business. They make a huge margin. They have been revamping their stores. They put a lot of money into remodeling, revamping, and so on and so forth. I think it's all good decisions that they're making, and I think this is a good rock bottomy sort of place to be into them. Our GNC position is not there. What? GNC. There it is. Oh, I see. We bought the stock. Oh, because they pay that dividend. I forgot they pay a dividend. Oh, they're not paying it now. Huh? They used to pay a dividend. When's the last time they paid? Well, I take it back. They don't pay a dividend. Oh, yeah, they did. Oh, okay. Yeah, they used to pay a 20-cent dividend. They haven't paid that in ages. So, oh, no. Okay, so they used to pay a 20-cent dividend. They haven't paid that in a while. I don't mind that they haven't paid that in a while. That's one of the reasons the stock tanked is because they suspended their dividend. December 2016 was the last time they paid it. Where is this thing? So the last time they paid a dividend was here, and after that, everybody got the hell out. They're like, oh, no dividend, forget this. I'm like, they're a company that likes to pay a dividend. They just aren't paying it now while they're redoing everything. They're conserving money, which makes sense. I don't mind that, okay? It's a good reason not to pay a dividend. You know, here's a good rule of thumb. A lot of people, a lot of companies you can buy really cheaply when they cut their dividends or stop paying a dividend or suspend a dividend, something like that. The stocks tank because a lot of people are just in the stocks for the dividends. They don't care anything else they just want the dividends. And if they're not going to pay the dividends to get it, they get out. Some funds are only allowed to hold dividend-paying stocks. So if the stock stops paying a dividend, they have to just dump the whole thing. Very unceremoniously, they just get out. But if you think about the stock as an actual business, okay, if you and your brother are running a store and the store is making money and you guys routinely take $1,000 a week out each, from the cash register, and at the end of the year you still have $100,000 left, and you guys are taking a salary of $50,000 each on the thing, and then you split the profit at the end. Now you have the $100,000 each salary plus the dividend plus your leftovers. That's how you're running your store. So you take $200,000. You're getting $1,000 a week out of the register. That's your dividend, and you are also at the end of the year you still have $100,000. Now, that's fine when things are going well. But what if you say, oh, geez, we have to buy a new refrigerator this year for the store, and that's going to cost us $50,000. So we're going to ignore that and just keep taking the money out, and at the end of the year we will have much less money. Or we can stop taking the weekly amount out, take less money weekly, cut the dividend, or not take it all, suspend it, use that money that we would have taken out to pay for this, and at the end of the year we're still going to show a nice profit. And there's different considerations you would make as a person for that, and companies make different considerations too about whether they want to please their shareholders with a dividend or so on and so forth. But a lot of companies have an attitude, and rightly so though, that they're like, hey dude, we would pay you a dividend if we had the extra money, but we don't this year, so we're cutting it. And when we're done with our store remodeling, when we're done remodeling 1,000-something stores, and when we're done retooling everything, and we're done with our marketing push, if all goes well, just like anybody who owns a store is going to say, if all goes well after I do all the stuff I think is going to make more money, then we're going to be happy to give you a dividend again. But meanwhile, you're a partner. You bought the stock. You're a partner in the company. You can't just drain all the cash, even when they don't have it to give you. But this is what dividend investors tend to do, and it's what they demand to do, and it's what they vote for when they're on the shareholder votes and stuff like that. They'll vote for this kind of stuff. They're like, I don't care what's wrong with the company, give me my dividend. And that's, again, another way that capitalism kills companies. You can't do that. You have to plan for your future. So rather than rejecting a stock that's doing that, I love it. I think this is great what GNC is doing. I'm thrilled that they're changing their store, and they realize that retail is changing and they have to change with the times. So I think these are all positive moves. They were down at 650 when we got in, and now they're up at they hit 10 for a while. Now they're at 8. And by the way, I'm very sorry we didn't take advantage of sell some calls in. But the bottom line is it's a great long-term hold. So what do we have? We have 6,000. Oh, we actually started sooner. I'm sorry, we doubled down at 650. We have 6,000 at 980 on the average. But we sold the January $5 call for 370. Oh, the net was really low. And we sold the puts, the 750 puts, for 340. Wow, that's crazy. So although we came in at 980, we netted 710 lower. So we netted in for $2 and God knows what. $2 and what if that was 710? 270. So we net in for 270 here. We're going to get called away at 5. So we were in no way, shape, or form were we looking for a big move. So we'll get called away at 5. If it's over 750, though, we keep all that money. It's all profit, and we're going to make a boatload of money. So there's $5 with 6,000 shares. We're going to get 30,000. No. Yeah, we're going to get $30,000 back. Right, and we're only in for $24,000. Yeah, I think it's 44. No, we're in for 14. So we'll get a double. Yeah, that makes sense. Okay, so we're in for 14. We're going to get $30,000 back at 5, but it has to be over 750, or we're going to get reassigned 60 anyway. But if we reassign, we'll do it again. Okay. And we still get the $30,000. It's just then we'll have to start again with these shares and then resell them and do so on and so forth. But if we make $14,000 on every 30 we put into this trade, if we net 14 in and keep getting 30 back, I don't care how many times we have to roll the trade. It's going to be a good trade. So again, I wasn't making a bet that the GNC would be some huge thing. That's only that clear as far as answering that question. We didn't play it to go way up. We just played it to stop going down. And therefore, if you could do a similar construction for the 2020s or something like that, I don't mind that. But we're not sitting there saying it's going to go to 10. We never said that. We said it's going to stay above 750 is what we said. That's all we ever said about it, was it would stay above 750 because we sold the 750 puts. But we also collected a lot of money for those 750 puts. So our net target is like at least 5. But we weren't being ambitious above that. TLX, one of the BDC's top picks, just got a big contract. I don't know anything about these guys. Biotech is like my blind spot, frankly. I can't follow them. I can't worry about what a $100 million biotech with no track record is doing. It's nice. I'm sure they're cool. I trust BDC. He's brilliant at analyzing these things. But to me, it's all a crapshoot. And they don't have options. I'm sure they don't have options. I'll look. They don't have options, so I have, trade all products. Yeah. Oh, they do have options. Anyway, they don't have options of tradable. Put it that way. So I've look, the zero bid. These are pointless. So they're not playable to me. It's just something I'm not going to touch. Ow, man, 1510. Not catching a break on those. And the Dow's still up too. So no good futures to play right now. It's a shame. No, it's not more money for the house down payment. You know what sucks about the college fund? It's really they got to spend it eventually because it kind of encourages them to go to graduate school, frankly. It was put in tax-free, and it accumulates tax-free, and as long as they spend it on legitimate college stuff, which includes housing and even includes like a computer for your college and stuff like that, like supplies. Maddie is an artist though, so I could probably buy like some expensive paintings with a college fund. Maybe we can get around it like that. But it has to be legitimate college expenses, and anything you spend that on, so tuition, room, board, supplies, you can use tax-free. Anything else though, not only do you pay the tax, but you get a 10% penalty on top of the tax. So you could basically, anything you're left over with, half of it gets taken by the government. That's why it was tricky. But I was like, I just felt better about fully funding it. Right when they were born, I fully funded the accounts because I was like, you know what, screw it. I said I'm much more worried about college costs going completely out of control in 20 years of inflation than I am about whether or not there's some extra money left over I have to pay tax on. So that was my attitude when I did it. It's obviously we had very low inflation, fortunately, for these years, but the cost of college has gone up right in line with what we put in. So when we put the money in, I think $100,000 that I put in at the beginning would have covered 4-year school at the time. Now it's a joke. So thoughts on IMAX? Still positive of the year? Absolutely. They've got all these big, huge movies coming out. Unless nobody's going, it's possible no one's going to movies anymore. But the box office trends have not been good. But I got to feel the fall. There's some pent-up demand. And there's a lot of big, big movies coming out, including Star Wars in December. How could that not be big? The new, real Star Wars with, Luke and everybody. So I'm still up on IMAX. Teva, another big turnaround story. They have a new CEO. They're probably going to tank this quarter. They've got no reason to have a good report this quarter. They have every excuse in the world. They have a new CEO coming in, new team, new this, new that. We're changing this and changing that. We're going to take these losses, blah, blah, blah. So that's what they call kitchen sinking the quarter. Because if you want me to be the CEO of your company, I'm going to come in and I'm going to tell you this quarter that I'm coming in, you take every freaking loss imaginable so that I have a fantastic turnaround story for my first year. You take massive losses now, and I'm guaranteed next year, 1 year from now, that I'm going to be able to stand in front of the board and say, we've made fantastic improvements. And I'm going to tell all the shareholders how great a job I'm going, and I'm going to earn my bonus because I'm going to easily earn my bonus because I've got such a low bar to clear. A lot of companies do that, and so don't expect anything good out of Teva this quarter. There'll be more pain ahead, and then hopefully we get a nice recovery into next year. GE, I think the dividend cut is kind of big. I think everyone is completely expecting a dividend cut at this point with GE. I'm fairly sure that is now baked into the cake. I like GE. GE is another one. It's a giant company. It's been around forever. It will continue to be around forever. They do so much stuff all over the world. And I think there was a sort of a run-up on the infrastructure thing, which was bullshit, which wasn't going to happen. And then there's disappointment, and now they're restructuring and turning themselves around. But this is a good bottom and a fantastic entry spot on GE. And we already have GE, I'm pretty sure. Do we? Yeah, there's GE right there. We have the actual stock. I like him so much we have the stock. So we bought him at $27.40, but again, not ambitious. It's very important on our portfolios. You have to realize that sometimes I buy something. This is all on 627, so I bought them for $27.40, but we sold the $25 call. So I'm already selling them at $25 when they're at $27.40. We really just went into this thing for the dividend. Where is that GCI? So here's Gavin. What do we do with Gavin? Yeah, Gavin we bought for $8.50. We sold the $7.50 call. We're already selling it for less. These are dividend-paying stocks. I don't care if they make money. Fidelity, I was gung-ho bullish on because we bought it for $32.30 and I sold the $35 call. Oh my God, I'm looking for a 10% gain. That's crazy, right? Look at Ford. Bought it for $12, sold the $10 call. GNC we talked about, bought it for $10, sold the $5 call. Hovnanian, bought it for $1.47, sold the $1 call. Does that strategy work? Oh, hell yes. Look at these positives. Not that one. Oh, GNC, because GNC took it bad. No, actually that's not true though, because this one just needs to play out because it's still on track. Even though it's showing the loss now, it's still exactly where it's supposed to be. So look at all these positive numbers, plus we're getting all the dividends for free. We took very conservative positions with very conservative targets, and we hedged the crap out of it, and so we ended up paying very little net out of pocket. That's the key to this thing, because if we're into GE for $27.40 minus $3.75 minus 6 minus 7, so 6 minus 7. So let's say we're in for like $20. What's the dividend of GE? The dividend's $1. So we're getting like a 5% dividend on the 20 that we actually laid out, and we're super well protected. So it's like free money. We're just collecting these dividends. That's how we set them up. And then in the worst case scenario, if we do end up ending, if GE does go much lower and we end up getting a sign, we end up having a lot of GE stock for a very low price, and then we can deal with it again and sell more calls and maybe more puts. So the only way we lose, and lose is in quotes, because basically losing means that we're going to get assigned the stock at a very low price, and it becomes a permanent part of our portfolio and pays us a dividend forever. So that's how we construct these plays. We go into them with a very, very conservative attitude, and we return stunning amounts of money, but that's just because we construct it properly. We're not taking big risks when we go into these stocks. So when I say I like things, that's why I want to make sure you guys take that for what it's worth. It's like I like them because I don't think they're going lower. I don't like them because I think they're going to go higher. I just think that this is going to be a nice bottom to invest at. And KMI, I don't know what I think of KMI right now. What are they doing? It's a good price for them. I mean, $18.50 is not bad. I would say it's got to be below 15 on the PE. What? What have they been doing? Income from operations, $1.2 billion. Oh, look at that net, though. Wow. That's amazing. That's not good. Declining revenues, not exciting net income, $700 billion this year. They're not declining. They're more like $14 billion there. And the income, that's quarterly, right? Well, that's 758.9. They're on track for $1 billion. And they're trading, oh wow, they're trading at $41 billion. Now, nope. I know the potential's there. They could, if things come back, they could turn up and whatever, but I don't think so. I mean, it's just too much. They should be trading at a 20 PE or 15 PE. They shouldn't be trading at 40 PE. I had no idea that they were so off. So I thought they were a much lower market cap there. So no, that's not. But why would how could that be appealing? Here's the thing. Look at Baker Hughes. It's Baker Hughes. Oh no, they're not anymore. They're in GE. All right, let's look at GE for that matter. Okay, so GE, by comparison, has rising revenues, and let's say 120. So they're 120. They're still in the 120s. They're still basically, so their revenues are steady, rising, whatever. Profits are erratic, to say the least. So 15 minus 6, 8, and how are we running on a quarterly basis? They're running at, God, what a mess. They're running at 4, 5, 6, 7. Yeesh, I wouldn't even want to guess their profits this year. Wow, that's a mess. I mean, I have to give them 6 at least, and let's see what they got in market cap. 200. Well, you know what? Not thrilling. So they are running at about a 30 PE. It's that, but again, but obviously it's better than Kinder Morgan, right? And Halliburton has got to be cheap. I think maybe nobody's cheap anymore. This is my problem in the market. Nobody's cheap anymore. That's you have to relatively GE is not a bad price, but it's still a crazy price to GE for anything. No major S&P component should be trading more than 25 times its value. So what's Halliburton doing? Halliburton's gutted their operation. Cash flow's way down. They can't make money. Oh, Forget it. I don't know. Boeing. Hey, how about Boeing? at least they got business. So Boeing, there you go. Steady revenues, steady profits, good for $5 billion. There you go. That's more like it. It's like a real company. And look at this, not $5 billion. This is $6 billion. So they're up 20% from last year. That's nice growth. And you get to buy all that for $153. Now we're talking. So their PE is in the low 20s. It's 2280 well, it says 2280 well. So their PE is in the low 20s, and they've got 20% growth. That's a company. That's something you want to own. Why mess around? Why would I want Kinder Morgan? I want to have things that give me a nice return, that are bringing in cash, that are making money on the money I give them. The other, you just can't buy things because you hear good things about this or that company. It's like relative to what? And we talked about that last week. What's the absolute value of a company? I don't really care what the company does. I care about whether or not it's reliably going to make money for the next 5 years. I'm going to buy it as a long-term investment. Is it going to keep growing or stay steady? Is it going to keep driving money to the bottom line? Is it going to give me a nice return on my investment year after year after year? And if you can't say that, why are you investing? It doesn't make sense to invest if that's not all happening. All right, so there. Let's talk about, okay, well, we're done with that stuff, right? So take a quick look and see how things are going. Everything is still up, of course. Fantastic. This guy's coming down a little bit. All right, we could play oil for a little bit of a sell-off. I do like oil short here. Let's officially go back and add an oil short. So we'll just take two of the. Okay, well, I wish I'd brought it up here. I don't like that. Well, let's play one of the 25 line and see how that goes. So shorting the current CL, which is a December contract, at 52.25, and we're going to be looking for 52, which will make $250 on the contract. That's going to be hopefully our goal. Might not happen right now, of course, but we'll see. And these guys I still like short. Anything below 15.10, I'm making the breathless short. And the Dow, I think we can add another one here. That brings my average up to 23,093. So I only need to get back to 93 to lighten back up on that one. So what was I going to talk about? Oh, yes, new plays, right. Okay, so here we are. So yesterday, we had some good plays. Well, how is XLS doing? Or FAZ, F-A-Z. Nope, still languishing. So FAZ is where it was, and we talked about that in the morning there. So I was making a play on FAZ, and I said I like the 1380, silver 1380, November 13 called 95 cents. And what we're looking for is some of these banks to come in and miss their, give a few misses or speak the financials. Or other trades we were looking at. In case you're not a regular PSW member, which you really only, I think the private chat says you'd be an options opportunity person to be on other people to see this. This is just a regular PSW chat room. And this is what goes on. People ask questions, and I answer them. And I'm blue. So anyway, so here's the IBM trade, which I talked about in this morning's post. And in this case, we like the short 130 puts for 12. We got a good premium because it was into earnings. And the 2020 130 160 spread for 12.75. So in other words, we're doing this even. We're netting into 75 cents on a $30 spread. Isn't that crazy? And you can bet today. Let's see what we got. What is it? The 2020 130 puts and the 130 160 spread. So IBM, and this is a very good point into earnings too. In fact, it's the same conservative thing. Look at these puts. They're down to like $9. They were 12, right? So they're down to 9. And the spread, the 130, 160 spread, was it? No. That doesn't make sense. Oh, it is. Wow, the 130, 160 spread. I'm like, it's so low, but I guess it wasn't low yesterday. So we went very conservatively. The thing was at 145. We took 145 in the middle of the 130, 160 spread. Now it's $33 minus 15 is what? 18. So it's $18 minus, let's call this 9 is 9. So it's net 9. So it went from 75 cents. 75. Yeah, 70. It went from 75 in contract to $75 per unit to now it's $900 per unit. So it's up more than 10 times in a day. But I just want you to understand how important it is. We were super conservative. We sold the 130 puts. This is an earnings play, and this is why you don't have to be the idiot paying a premium to buy calls into earnings or sell puts into earnings or whatever. This is a 2020 play that made 1,000% in a day. And if IBM had tanked, nothing bad would have really happened. If IBM had gone down 10%, it still would have been at 130. And our puts would be, obviously we'd be losing money on paper, but unless something devastating had happened to IBM, we'd be like, oh, well, they'll recover. And the same thing goes to the spread. We own the 130 calls. So unless IBM went more than 10% down, which we thought was extremely unlikely, then we felt that it had a very, very good chance of paying us more than $75 at the end of the spread. As it turns out, we're immediately getting a 1,000% return, and there's still 2,000% to go. Still a good trade. It's a net $9 trade that still will return 30 at 100 at the price it's at now. It isn't as good as it was yesterday, but it's still a damn good trade. But the point I want to make is that's an earnings play. That's a high return earnings play where the worst case scenario was owning IBM for $130.75. And if your attitude is, well, who the hell wouldn't want to own IBM for $130.75? That's why it's a good play. That's what makes it a great trade. So don't get trapped into thinking you have to take short-term positions to make short-term money. You don't. You can set up a well-constructed long-term play, and if you get a quick pop, you can cash it out, or you can say, okay, you know what, I'm going to hang on to this and collect the rest of my my $30. Still $21 left to make. So we talked about IBM. What did I say about oil? I don't know. If we talked about miners we like. I'm not going to get heavily into it, but here's Wheaton. Here's Barrick Gold. I like them here. They're cozying up along this little line, which is probably going to move up, and then they'll get into a triangle squeezy thing right about here. So target right now would be 17 for the next couple of months. And then hopefully the big pop as the market collapses and gold skyrockets into the beginning of next year. Coeur d'Alene, another good one, and again down in the dumps for now. Harmony down in the dumps for now. And Northern Dynasty is a little bit special because they don't produce any actual gold. They just have the rights to produce a massive, massive mine that is many years away from production. So it's all speculation, but we love them. And they're up here now. So they've already broken up and out. Williams-Sonoma this was all sent out as a top trade yesterday. Williams-Sonoma, we decided to add to the portfolio. We used to play them when they were down here. When we were down in this area, we played them. And then we got out when they were up here, or not even here, I think it was last year. Anyway, so I've been itching to get back in, and we finally, the 2020s came out. That's why now, is really the 2020s came out. It wasn't because we didn't like them here. It's just I was like, yeah, let's wait and see, and let's see about earnings and whatever. But anyway, fantastic company. We love it. And it's a similarly conservative play. We sold the $40 puts. They're way the frick up at $50. We sold the $40 puts because they're paying a crazy $5 for the $40 puts. It's more than 10%. So puts are 20% out of the money. So what are you getting? You're getting a 30% discount on your entry. Your entry is net $34.60. That's crazy. We love trades like that. It's so much money, we only had to sell half, and we bought the 47.50, which is actually aggressive. We bought the 47.50, which is right here, 57.50 up above the chart, full call spread. So but it's 2 years out, so in 2 years we want to get to here. And we will make, it's only net $1,000, and it's a $20,000 spread. This thing will make $19,000 at 57.50. Again, do not have to play short-term trades to make incredible amounts of money on a hedge, on a spread. You can construct a good spread to do all these things. What do we got here? Oh, this is the butterfly portfolio. We did an update of that. Not very exciting. Nothing. I mean, it shouldn't be exciting. It's supposed to not be exciting. Oh, well, maybe one of these charts, though, I can tell you if somebody's interested to buy. Disney, Disney's very cheap. I like them down here below 100. P&G is expensive. Texas Instrument, we're kind of moving towards almost a short position on them because they're so expensive. They're so crazy expensive. I mean, it's probably expensive too. So no, there wasn't anything exciting there before. And da-da-da-da-da. And I was bitching about the advanced declines, and that was it. Okay, so that's it for there. And then today, we had a couple of trade ideas today. Well, here's Super Value. This is the weirdest thing, right? They popped, and then they fell down like really hard. So they were up 10% and then down 10% for the day. 20% spread. Craziness. So I still like that. Great opportunity to get in. Talking about wealth inequality, the oil, petroleum like that. Oh, one of the OPEC countries said they don't think that there's a need to continue to pull in production. So I thought that was good, but it's not being reflected in oil dumping or anything like that so far. Here's WBA. We like that one. In fact, we decided to sell some puts in the long-term portfolio because I think that's a very, very nice. Walgreens. I think that makes a very nice floor down here. You know, they Walgreens and Boots merged. Boots is a very, very big European pharmacy based in England, I think. And they bought Walgreens, and Walgreens is gigantic in the cities and all over the country. There's plenty of them. And Boots is actually, you know, if you go into a Boots around the world, they're really nice. You know, way nicer than American pharmacies. And they're going to start making all the Walgreens look like Boots, like really nice. Just nice places to shop. And I always see someone in the city looking like that. I think it's a different experience. It's something that's probably going to sell well, and it's a good business. And they sell more sundries like makeup and things like that. They press more shopping items. So this thing was behind because when we did this news item, it still said they were up 9.3%. It was so weird. It really was. Just a strange move. Here's OPT. We were talking about before, up 41% today. Very nice. Congratulations, Albo. Or 1020 or wherever that was you had it. And And that's where we were. All right, so everything seems cooked there. Any other questions? No, all the questions died out. That's fantastic. We're coming to the end game here. So basically, like I said, I just can't, at this point, I cannot in good conscience risk my children's money risk my children's college education. And again, obviously, that's silly because I've got other money. But that's the money I put aside for their college, and I refuse to risk it on this market. And that's how I feel that. And again, and it's not just that, though. It's money I couldn't hedge. Not directly. Because if it's lost, it's that tax-free bonus money that's lost that you don't get back. In fact, what happens is if I replace it, you have to think about what the mechanics are. If I had the attitude that I would risk their fund, so let's say they have $250,000 in the fund, and let's say it drops 20%, and $50,000 disappears, right? Fine. So I say, okay, well, no real harm done. I'll just put another $50,000. But the $50,000 I have to put in to replace it is now after-tax money I have to replace it with. You can't replenish the fund tax-free. It doesn't work like that. So I'm at, max contribution. That's it. So effectively, if I'm getting taxed like about 40% or something like that rate, it's going to cost me $90,000 out of my pocket because I was careless with their money on the college fund. That's crazy, right? That's not an acceptable risk. Now, I could get fancy and say, well, I could hedge myself against a $90,000 drop personally and then leave their money in the fund to run in case it does. But why should I do that? Because they're covered. See, again, you have to do the risk assessment. Why should I go through all those gyrations to protect their money when I can protect their money by going to cash? They've got enough for college. It's done. There's nothing to be greedy about because any excess money in that account will be taxed at like 60% coming out. So I have no incentive to build it up any further. It's going to pay for 6 semesters at $50,000 a year. Or 5, anyway. Well, 5, and then obviously I expect a little bit of growth between now and then. I'm not permanently out. I'm out for now. But at the moment, it's covering 5 semesters at $50,000 a year, and that's assuming no aid and no nothing else and whatever. So they're good for college. And it's not worth the risk. It isn't worth risking the extra money. For that same $90,000 I would have to replenish with, I would rather pay for their grad school should they need grad school or something else, rather than risk it rather than have to take the same $90,000 and just pay for their college because we blew the money that they needed. So it's silly, right? You have to look at your risks and evaluate things like that. You always have to say sometimes, and your stocks too, when you're going through the portfolio, and when you go through this exercise over the next couple of days about portfolios, you've got to look at your stocks and say, this is up a lot. Should I really keep at it or should I cash it? Now, we'll look at a couple right now. I'll show you. The long-term portfolio? Yeah. So here's Barrett. They're down. Not change. I like them, so going forward. Here's Berkshire. It's up 76%. I have to wait until January 2019 to make the rest of to make the other 24%. I'm sorry, 24%. So is that worth it? I'm going to make another 1,000 by tying this up until then. Now, it's a 125 put. It's got virtually no chance in hell of being hit. Berkshire's not going to drop $70, like 40%. It's not going to drop 40-something% between now and next year. So it's incredibly unlikely, but still, it's not worth keeping open. I hope they do drop a bit, and then maybe I'll sell something higher. But this put's not doing me any good at all. And because I have the put, I still have to hedge it somewhat, and it's not worth it. It's not worth the margin. It's not worth the hedging. Boom. Kate. That's in April. They're at 42. Will they fall to 40? A little dicey. I have to think about that one, okay? Like Kate, like him at this price, probably will keep it, but you have to think about that one. how safe is it compared to how long do you have to select, and how good do you feel about what's going to happen if the market drops 10%? What's going to happen in this trade? Well, the market drops 10%, I'd be inclined to roll it, so it's not so bad. It's Dunkin' Donuts, same thing, no different, same kind of play. Very small position though, that might make me more inclined to keep it. ESRX is a loser so far. I still like them. I think they'll come back, and they're down, but they're not really tied to like the economy so much. They have their own issues that they're down. So probably inclined to keep it. I want to see what the roll looks like for 2020. Here's Fuel Cell. Again, very slow moving at the moment, so not exciting. GoPro just had good news today. Not hugely popular. They had some nice notes today from analysts or whatever. So do I feel like the $8 put is in jeopardy between now and January next year? And no, I don't, not really. But is that the way I want to make half of that money? Is that the way I want to make $1.69? Don't know. I have to think about that. Here's INFN, and they are up 68%. See, once it's 68%, I'm very inclined to take off the table. Again, not worried about it. Don't think they're going to fall below 8, but they're only at 850. They could fall below 8, and then it look like an idiot, right? So why not take it off the table and be sure? And here's Restoration Hardware. It's another one. We love them, but there's a stock where if the market collapses, they will go right down with it, so everybody's going to freak out. But it's a $25 put, and the stock's at 80. So, no, probably not. Out of principle, I'm not going to pay somebody $1.90 because I'm not in the slightest bit worried Restoration Hardware is going to go to 25. And if it does, I'd be buying a lot of it. I don't mean this a lot of it. I mean like many times that much. Starbucks, same thing. Really good company, 10% discount. But I'm not sure if it's worth keeping and worrying about. Here's C. They're probably done for. They're at. I sold the 40 put, 10% drop. Puts in the money. And it's only 60 cents left. I can find something to make more than 60 cents on with 10 contracts. We just did Williams-Sonoma. So why am I sitting on this to make $600 and taking up a slot? Doesn't make sense. All right? So that's how we're going to go through the whole portfolio. We're going to see what's worth keeping, what's not. We want to raise more cash because it just makes me feel good. It's going to make me feel a lot more comfortable. I'll be a lot more inclined to jump on new trades if I know we have bonus cash. Also, by the way, raising more cash in the long-term portfolio automatically makes the short-term portfolio more of a hedge, right? Because I'm hedging against less stuff. So the short-term portfolio is languishing at about 417. We're not going to change these again. We already did enough changes last time to lock to have some really good leverage to the downside. But now, if we protect less on the long-term portfolio, that means we're now overhedged to the downside, and we can make some moves like buying more stuff. So it's a little schizo. I'm getting rid of things that I'm in any way, even the tiniest bit not confident about. I'm going to get rid of it. And at the same time, though, during earnings, we're going to be looking for those bargains, things that we think have hit a good floor, and we're happy to jump in and buy more. So tune in next week, and we'll give you a little bit of an update. There's going to be a lot more earnings next week, so it'll be kind of exciting. All right, and for me, I need 1503 over here. I need anything below 23.1 is good for me here. Oil, I want to see go below 52. Oh, wow, look at gasoline flying. When gasoline hits 165, that's going to be a nice short, but you've got to have a tight stop above 165. And then we certainly like silver long at 17. That's a good one. And coffee, the KC, this is just a regular coffee. This is, I like the, not really the H8. What was I playing? The U8, wasn't it? Yeah, it's U8. It's through next summer. I like the KC U8 that goes to next summer. Because then you get the whole season of the summer into there. It's 135. It's a lot more money, but it should probably go up nicely with the rest. Or with it Visa. Isn't it Visa also? Nope, there isn't a V. Why isn't it? Anyway, so it's KCU8. And then there's H8 also on that one. The natural gas is what the H8. 28. No, I might have that mixed up. It's KCH8. Sorry, it's KC8. It is KCH8. It's March Coffee, which is at 128. So it's only a few points higher than the current contract. So that's definitely worth doing at 128. The other one was the natural gas is the one that I got the longer term contract on. Oh, where is that? H8. NG. Do they have a V8? They have a V8. That's where I got mixed up. The natural gas V8 down in the 290s here is a good deal. And as you see, 295 is a nice bottom. But anything down around here, it's at 299 right now. Once it gets over 3, you can use 3 as a stop. But again, this is all the way out to next October. It's a 1-year contract. So many, many things can happen in a year, and you really don't want to get caught in a big downturn on natural gas. Anyway, all right. We're going to call it a day there, and thank you, everybody, for coming. Oh, wait, what's this? Oh, now you're asking questions? You guys are killing me. All right, let's see. Do you still FTR? I still FTR. Yeah, I like Frontier. It's a long-term turnaround story. You know, look, when a phone company, it's like when Verizon was building Fios at first. They were spending so much money on the fiber, and everybody was freaking out and selling the stock and blah, 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 and then eventually it paid off. That's kind of where FTR is now. They are building out a fiber network. They bought a lot of Verizon's Fios stuff, and it's going to take years for them to see a proper return. If you want to get in at the rock bottom prices, this is very, very possibly it. Obviously, the worry is that they'll go bankrupt because the rates are going to go up while they still have this massive debt. But that's how phone companies work. They go into massive, massive debt to build infrastructure, and then they build it. And, of course, obviously, the money doesn't come right back. It comes in dribs and drabs as all the monthly subscribers pay for the high-speed access. But the only real worry for FTR is whether somebody invents some kind of wireless system that's faster than or as fast as high-speed fiber, and everybody no longer needs any kind of phone company. Other than that, they're probably going to need shape. What do you need to see to make you tilt the portfolio bearish? We are tilting bearish. That's what I'm talking about, though. We are cashing out more longs, and we are buying more puts. Now, to the extent that the market doesn't, obviously, if earnings are, whatever the earnings are, if the market's crashing next week or the week after, we're not going to be buying anymore, and then we're going to let the hedges do their job. But at this moment into this weekend, we're going to be cashing out, and that's going to effectively tilt it more bearish. The same hedges are now, it's like the corporate buyback. The same hedges are now protecting less longs. So that gives them more, that turns us more bearish automatically. Then if we don't get the drop, then I say, oh, geez, we got a ton of hedges, and we need to buy some longs to make up for it. So then we go bargain hunting for more longs. What do those lines represent on TRS? How do you add those? It's a study. It's called pivot points. When you're on the chart for Thinkorswim, you right-click on the mouse, and you then go to studies, and you say add a study, and it's a trend study, and then you go to P for pivot points. See that? That's what it is. It's called pivot points. And when I do a study, I do not mess around and change the parameters of the study, because the whole point of having a support and resistance lines is I want to know what everybody else is looking at. So if I'm going to make my own, then I'm the only one looking at it. Then how is it valid? It's valid when a lot of people look at it and make their decisions based on these lines. That's what I like to know. I like to know what people think are the supports and resistances. It helps to get an idea of where things are likely to turn. All right, now I'm done. I tried to get out before, but you pulled me back in. All right, guys. Thanks for coming. We'll do it again next week. All right? Take care, everybody.